So a head fake, what does it mean? I was saying this earlier. Just knowing what a pattern looks like and knowing the name of it isn't enough. You got to be able to kind of talk through what a pattern is doing. In order to read it and for it to have any predictive value, you've got to be able to say why it's doing what it does. How does that clear the way to go down or to go up? Because a pattern and recognizing a pattern, well, anybody could be taught to say, see this pattern? Yeah, okay. Next time you see it, let me know. But what are you going to do? What kind of value does it have? It's got to be able to help predict the next move. And so a head fake, if we just use what's drawn up, first of all, you have to identify a consolidation, all right, which could be this. And then a head fake is we're going up. No, we're not. And we go down. And it's just this little move above the top that creates the opportunity to, in this case, have less shorts and maybe more longs. This combination. Why? More longs, they're playing the breakout to the upside. And so they're long, thinking that it's going to be a breakout and going to follow through up, but it doesn't. Comes back down, and they're looking around saying, uh oh. And then less shorts that get shook out because of buy stops that are put above the top of a consolidation. Everybody knows how that feels. You get stopped out, and it turns around and goes back down. Let's say you're short, you get stopped out, take your loser, then it turns around and goes back into the direction you thought it was going to go, but you're no longer short. Less shorts. If indeed a short is a future buyer, less shorts mean less buyers. And if indeed a long is a future seller, then more longs mean more sellers. I don't know about you, but this combination of less buyers and more sellers is the combination that doesn't help price go down. It's needed for price to go down. I'll never forget, and I'll never stop telling this story when someone once said, yeah, that would be helpful. No, it's not helpful for price to go down. It's necessary. The combination of less buyers and more sellers. So if you look at this, you could see the consolidation box that we had right here where it was going sideways, starts to peak to the upside, and then you get the not so fast. Now, this wasn't a classic example of it, but if you look at the number bar, the footprint over here, you could see it jump up and then right back down. So it looks like it's going to go up if you're looking right here, and then it turns around and longs actually come in right there. See these longs come in? It flips our laser from red to green, means more longs. More longs is more sellers. And it slides lower. And that was the moment where you create a better bias, more objective bias, a bias with a better probability that the downside's the right side. Head fake. Don't forget what it is, what the pattern is, and how it's useful in predicting future direction, or step one. Could be bearish in this case. Even though we're above the PWAPs and everything else, if you see the example of a head fake, you fake up to go down. What I just walked people through is why it creates some predictive value. And the downside might be the right side after a head fake like this because you trap longs, more longs, and you shake out shorts, less shorts. Always kind of go back to how you feel when you get stopped out, how you feel when you've got a long or a short, you're almost filled for a winner, how you feel when price starts getting back closer to a stop that you have in the market. Because how you feel is also how the market feels if a lot of people in the market are experiencing the same emotions as you or the same scenario as you. Now, if you're the only one, it's not going to matter. But if a lot of people have a buy stop in a certain area, the market's going to feel the way you do every time it gets closer to that buy stop. It becomes a self-fulfilling prophecy. It's just a good way in life, but also in the markets to understand how other people feel based on how you feel in the same situation. Because after all, we're all human. That might be a little difficult to predict how a dog feels. They're not humans. But if it's another human you're trying to predict, how do you feel? And gives you a little bit better insight on how they feel, and rationalizes it a lot better. And then again, there has to be a lot of those feelings for then the market to be used in this example. When the market is showing a head fake pattern, that's the element of many people getting shook out of a short position and maybe trapped into a long position. And now the market has a better chance of going down because of getting to what we need. Anytime that you predict downside, right side, you need more sellers and you need less buyers. You need this combination. If you just get more sellers, yeah, you might get some downside. But when you get both, then you have both sides to create maybe some faster downside. More sellers, less buyers. More sellers, less buyers. Future buyers and sellers. If you're trading, you're predicting where price is going to be in the future. So to do that, you got to predict future buyers and sellers. Where are these guys going to come from?